Yields on the 10-year Treasury falling to levels not seen since February this week as investors bet on rate cuts this fall. So how does this change the investment rationale for your cash allocation? Joining us now is Olaolu Aganga, Mercer U.S. CIO. And Olaolu, it's great to have you weigh in on this. I mean, obviously, there was a somewhat momentous tone to Jay Powell saying it's time to adjust policy. This is the first time we're having a rate cutting cycle initiated in 5 years. Does any of this, do you think, serve as a reason to rethink asset allocation?
I mean, from a tactical standpoint, yes, and thank you so much for having me, Mike. The time has come for policy to adjust is the quote that's been heard around the world. From a tactical standpoint, if clients are currently sitting in on cash, for those with operating pool shorter duration, if you can lock in rates, particularly given the inverted shape of the curve right now, shorter dated levels, it absolutely makes sense to be able to do so given the opportunity. Now, our base case is still, and we've been saying this for some time, that the Fed is going to cut rates. We're expecting 25 basis points at each of the next few meetings. Maybe if there's a deterioration in the labor market, 50, but lock that in for sure if you have the opportunity. And then also, you know, it's great for equities as rates go lower. Yeah,
I mean, it's an important distinction. I mean, you're not necessarily fleeing toward long duration bonds because you think things are going to get very bad. But it is interesting in this, even this last little period in the markets, that you have had good offset between how bonds and stocks have behaved. In the correction, for example, we just had a few weeks ago, bonds did do their part, I guess, in acting as a buffer. But given, though, that you think that equity should continue to do well, it can continue to reward risk-taking out there, where else should we be emphasizing?
So we have been overweight equities in our portfolios, tactically speaking, as well as, you know, lower rates is good for longer duration assets, again, not necessarily moving there. If you're looking geographically, we were overweight in Japan. So the volatility that we saw a couple of weeks ago, where we had big pullbacks in the Japanese equity markets down 20%, we used that as an opportunity to add. So we are longer there. But broadly speaking, equities, longer duration assets, this is a good environment. But the measured pace at which we're going to see rate cuts, we are looking very closely.
I know you have some views as well on private credit, obviously very fast moving and fast growing area of the market on both the demand and supply side, I guess. Investors like it for the yields and borrowers like it for the efficiency, I guess, and speed. What are the implications of being at this point in the cycle and rates coming down for that asset class?
Yes, we've loved private credit. You know, if you were to start thinking about the asset class, it's a floating rate nature. So when rates are high, it's great, even with our expectations of a rate cut, which is our central case as a soft landing. So gradual cooling of the economy, gradual rate cuts. Yes, there have been a lot of entrants within private credit. The estimated assets under management is about 1.7 trillion. And some of that suggests if you're looking at maybe direct lending, for example, that's like half of that. But pockets within the private credit space is where we are focused on. There are about, you know, 4 sub-strategies. So direct lending, opportunistic credit, structured credit, and specialty finance. So for us here at Mercer, we have the opportunity of being a part of Marsh McLennan, right? So he takes a view on risk and gives us insights to some of those trends. But what we are really looking at there is some of the asset-backed deals within private credit.
And you did mention Japan as a market you liked, and you were able to buy that sharp break in the index. Is there elsewhere outside the U.S.? Is anything compelling, or is it still better to stay closer to home?
I mean, it's better to stay closer to home. But again, Japan is part of where we're really focused on. We've talked about emerging markets. It's very bifurcated, somewhat dispersed. We're looking at China given valuations, but that is still a slower moving area. But the overweight that we had tactically looked at within portfolios have been more developed, and then Japan.
And then in terms of just where you sit and your view on kind of pension fund dynamics, I guess. A lot of talk for a while about how there's overfunding in private pension funds to a degree and what that might mean for what they're doing in terms of how much risk incrementally they'll take or withdraw from the markets.
Yeah, so it's a trend that's been happening for some time, but of course it's been more pronounced somewhat the last few years. So the funded status for corporate pensions has been soaring for the most part. So from a risk perspective, it means that they're able to de-risk. So you don't necessarily need to be able to take that much to be able to get the returns. The equity markets have been soaring, so they've been taking that down. It then means that they're able to focus on some of the liability hedging that they have, right? So the benefits that they've promised to retirees for some time, the equity markets have been good for them. So more and more, we're starting to see what they call pension risk transfers, where you're taking the pension and moving them to other areas. But overall, pensions have been doing well. We're seeing all of that in corporate balance sheets, those types of things.